Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Fortune Brands Innovations Inc. annual report. Fortune Brands Innovations Inc. offers a diverse range of products and services across three primary segments: water, outdoors, and security. The company's water segment provides faucets, accessories, kitchen sinks, and waste disposals under various brands such as Moen, ROHL, and Ryobil. In the outdoors segment, Fortune Brands Innovations manufactures and sells entry door systems, storm doors, composite decking, railing, and cladding under brands like Therma-Tru, Larson, Fibron, and Fypon. The company also offers wide-opening exterior door systems and outdoor enclosures through its Solar Innovations brand. The security segment is a significant part of the business, offering locks, safety devices, connected lock solutions, and electronic security products under Master Lock, American Lock, Yale, August, and SentrySafe brands. These products cater to residential and commercial customers, providing peace of mind and protection against various threats. Fortune Brands Innovations sells its products through multiple channels, including kitchen and bath dealers, wholesalers, industrial distributors, home centers, showrooms, e-commerce platforms, and other retail outlets. With a presence in the United States and internationally, the company has established itself as a leading provider of home, security, and digital products for various applications. The stock price of Fortune Brands Innovations, Inc., FBIN, has experienced a significant drop of over -14.19% within the past year due to a combination of disappointing financial results, weak future guidance, and a leadership transition. One of the key events that contributed to this decline was the company's fourth quarter 2025 earnings miss, where it reported adjusted earnings per share of $0.86, missing the analyst consensus estimate of $1. The revenue also fell short at $1.08 billion, below expectations of $1.14 billion, and a 2.4% decrease compared to the same period last year. The company's outlook for fiscal year 2026 significantly disappointed investors, with a projected earnings per share of $3.35 to $3.65, well below the consensus estimate of $4.08. Management attributed this to a continued uncertain external environment and anticipated a low single-digit decline in the global market. The leadership transition announcement, where CEO Nicholas Fink would depart on April 1, 2026, to be succeeded by Amit Banati on May 13, 2026, also added to investor uncertainty. This change occurred during a period of weak performance, which likely exacerbated the negative sentiment among investors. Additionally, price target reductions by analysts and general market challenges throughout 2025 contributed to the decline in stock price. Analysts such as Bank of America and RBC Capital reduced their price targets due to concerns over tariff impacts, housing market uncertainty, and softened demand. The company's withdrawal of its full-year guidance also added to the negative sentiment. Overall, the combination of disappointing financial results, weak future guidance, leadership transition, and general market challenges have contributed to the decline in Fortune Brands Innovations' stock price by over -14.19% within the past year. Fortune Brands Innovations, Inc., market capitalization of $7 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Fortune Brands Innovations, Inc. holds a significant advantage in their industry. And Fortune Brands Innovations, Inc. trades at a higher price-to-earnings ratio of 23 times, and a higher price-to-book ratio of 2.81 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 63% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and his management is unable to expand the business. The primary drivers of revenue growth or decline can be identified through a review of the financial report's extracted summaries. On the growth side, acquisitions, refocusing business on high-growth areas, and consolidation of regional offices into one campus headquarters have contributed to increased revenue. New product introductions, disciplined pricing actions, and productivity gains across segments have also driven growth. On the decline side, international markets, unfavorable foreign exchange, and a contraction in the U.S. home products market due to lower new housing construction and home repair/remodeling spending have led to decreased revenue. Sales volume decreases in China and lower organic sales volume have also contributed to declines. Other factors that may impact revenue growth or decline include seasonality, laws and regulations affecting business, housing market fluctuations, economic conditions, consumer demand, availability of financing, competition from price-conscious consumers and private label brands, product development and innovation, and changes in consumer preferences and trends. Net income experienced a significant decline between 2024 and 2025, decreasing by $173.1 million, or 63.3%. This downward trend continued throughout the 3 fiscal years ended December 27, 2025. The decrease in net income was further exacerbated by an impairment charge of $50.1 million in Q4 2025. Profit margins also suffered a substantial decline, dropping from 16% in 2024 to 11.6% in 2025. This reduction can be attributed to the decline in net income and increase in non-cash expenses. The decrease in profit margins is evident when comparing the net income to total equity ratio for 2023 and 2024, which decreased from approximately 19.5% to 12.5%. The reasons behind these changes are multifaceted: decreased home improvement, repair, and remodel activity in North America and China, as well as reduced new home construction activity in the U.S., contributed to the decline. Additionally, material lower margins due to tariffs, increased costs of raw materials and energy, supply chain disruptions, and inflationary pressures all played a role. The decreased availability and increased prices for commodities and energy further exacerbated these issues. The company's financial performance indicates a strong ability to generate cash from its core operations. The data shows that the company has consistently produced positive operating cash flow, with a notable figure of $478.6 million in 2025. This is further supported by the fact that operating cash flow from operating leases is also positive at $56.7 million in 2025. Overall, these numbers suggest that the company is successfully managing its finances and generating sufficient cash to support its operations. The company's debt level has undergone significant changes over the past 2 years. According to the financial reports, the total long-term debt decreased by $128.4 million between December 28, 2024 and December 27, 2025. This reduction in long-term debt was accompanied by a decrease in short-term debt from $499.6 million to zero. However, the company's long-term debt increased during this period, indicating that the overall debt level has changed significantly. In contrast, the company's interest expenses have shown relatively minor fluctuations over the same period. The interest expense decreased slightly between 2023 and 2025, with a slight increase of 1.9% from 2024 to 2025. This indicates that while the company's debt level has undergone significant changes, its interest expenses have remained relatively stable. The company's performance was marred by poor results from several segments and regions. The outdoors, security, and water segments all experienced declines in net sales, with the outdoor segment suffering a significant drop of 2%. Operating income also took a hit across these segments, with the outdoor segment experiencing a staggering decrease of $57.8 million. Internationally, the company's performance was equally dismal. International markets, which accounted for approximately 16% of net sales in 2025, saw a decline in sales. The U.S. home products market also contracted due to a drop in new housing construction and repair/remodel activity. In contrast, no segments or regions were highlighted as performing well. This suggests that the company's overall performance was lackluster, with few areas of strength to offset its weaknesses. To improve its fortunes, the company will need to address these underperforming areas and identify opportunities for growth in other segments and regions. results. Management is confident in their strategic plans to drive long-term value creation for the company. They expect to continue investing in brands, products, and services to achieve growth and become a leader in the industry. The focus will be on digital transformation, talent acquisition, and innovation to stay ahead of the competition. The company aims to outperform its markets in growth, profitability, and returns to drive increased stockholder value. Management is optimistic about the future prospects due to recent acquisitions and productivity improvements. They also have a strong cash position, which provides sufficient liquidity to support working capital requirements, capital expenditures, and other contractual commitments. However, management acknowledges potential risks and uncertainties that may impact the company's financial condition and results of operations. These include fluctuations in the housing market, cybersecurity threats, and regulatory changes. Despite these challenges, management remains optimistic about the company's ability to navigate them and achieve its goals. The company has made several significant acquisitions and divestitures over the years. In terms of acquisitions, the company has purchased Emtek and Schaub's premium and luxury door and cabinet hardware business, as well as U.S. and Canadian Yale and August residential smart locks business. Additionally, Wise Water Solutions, LLC, doing business as Springwell Water Filtration Systems, was also acquired. The total cost of these acquisitions is substantial, with the Emtek and Schaub business costing $152.5 million and the Yale and August business costing approximately $24 million. These acquisitions are expected to bring in new revenue streams and expand the company's product offerings. On the other hand, the company has also made significant divestitures. MasterBrand, Inc. is being spun off in a tax-free transaction, which will allow it to operate independently. The company has also transferred $266.6 million of pension plan obligations and related assets to an insurance company in 2024, and plans to transfer the majority of its pension plans assets to an insurance company in exchange for an annuity contract in 2025. These divestitures are expected to simplify the company's operations and reduce its financial liabilities. Overall, these acquisitions and divestitures demonstrate the company's strategic focus on growth and cost management. The company's financial activities have been marked by a commitment to returning value to its shareholders. One key aspect of this is the payment of dividends, which has been consistently reported throughout various sections of the annual report. On page 30 and 32, it is explicitly stated that the company has paid dividends, indicating a clear intention to reward investors for their loyalty. In addition to dividend payments, the company has also engaged in share buybacks, another way to return value to shareholders. This strategy is evident throughout the report, with mentions on pages 20, 24, and 30 highlighting the company's efforts to repurchase its own shares. Furthermore, page 71 provides additional context on this initiative, underscoring the company's dedication to maximizing shareholder value through strategic financial decisions. Concerns about inventory buildup and supply chain disruption are evident throughout the summaries. Inventory buildup is a concern as indicated on pages 33, 59, and 86, where it is noted that capitalized inventories have increased significantly from $18.1 million to $26.7 million. Supply chain disruptions also pose significant risks. On page 8, consolidation of distributors or retailers, financial instability/default of a distributor/customer are highlighted as potential causes for disruption. Additionally, pages 10 and 24 mention various factors that could lead to supply chain disruptions, including fluctuating interest rates, foreign exchange rate fluctuations, new tariffs, IT system delays, cybersecurity incidents, near-term supply constraints, labor constraints, freight constraints, and volatile geopolitical environments. Furthermore, a specific incident on page 93 notes a fire at a manufacturing facility as a cause for concern. These concerns underscore the need for careful management of inventory levels and supply chain resilience to mitigate potential disruptions. That concludes the financial summary for Fortune Brands Innovations, Inc. Feel free to comment below, and I will be happy to answer them when possible.